in listen-only mode.
Good afternoon, everybody. Stan and Jack here, and we're doing a webinar on trading skills, how to use technical analysis in trading. That's what we're going to be doing today. And what we're going to do is we're going to go through charts, and we're going to talk about three things. One is trading setups, and I have here also only setups. Hey, Jack, I'm getting some hissing on the line. I think it's coming from your microphone, maybe?
Okay. Well, actually, it could be running from the heater in my room. I'll turn it off.
And by the way, that just cut it out. Whatever you just did, it's now silent. There you go. Okay.
I turned off the heater.
Okay. So the trading setups, having a trading plan, and managing risk. Okay. And I think that, how can I say this? And I've said this before on webinars. You know, you can have the best technical analysis in the world, and you can lose money. Okay, and so part of it is knowing how to manage risk, knowing how to trade setups, and the other part of it is your headset in terms of your psychology. So with that said, Jack, I think what I'd like to do is talk through ES and then throw it over to you and have you talk through trading setups on a couple of other instruments, and we'll kind of go back and forth and talk about managing risk at the end.
Sounds great to me.
Okay, cool. All right, so let's talk about trading setups and let's talk about technical analysis. Okay, so I'm going to take some examples off of this ES chart, and I'm assuming you guys can see it. I also want to say that in your questions tab, if you have questions along the way, ask them. We will deal with them. Okay, so I want to introduce just a couple of very simple concepts in TA, and one of them is a floor ceiling. Okay, we've been looking at this impulse playing basically floor ceilings, and I'll just give you a couple of examples here. So from the X, how would I be trading this sequence from the X? Well, the first thing I'm not doing is I'm not trying to pick a top. Okay, I'm paying attention to support and resistance, and I'm looking at either day trading or swing trading support and resistance. Okay, so the first thing I want you to notice is this double bottom here. Okay, and really technically it's not a double bottom. We would have to see the B go slightly beyond here, but basically when you see a three-wave up move and a back test like this, you can expect an impulse. Okay, so this is nothing more than a three-wave formation. We had a target here of 79s, but do you know if the target's going to play out if you're here? No, you don't. So you wait for a setup. This is a setup. Okay, you would get long here with a stop below the low. Okay, and you'd let it play. Now, that's a fairly simple trade, okay, but what I want to talk about here are floor ceilings. So here's an example of a floor ceiling. This was resistance right here, okay, and I don't remember the level, but I'm just going to use this blue line here. I'm going to make it fat so everybody can see it. I'm going to do a medium line. Let's do a real thick line just to do it thick, okay. So this is a floor ceiling, okay? So here's your impulse, there's resistance, you get a rejection, okay? You get a rejection, you remember that level, okay? And that level there is 52s. I'm sorry, 56s, right, okay. Now I remember. So 56s played out, we got the rejection. You would get long here, okay? And you would wait for this to play out. Now, our basic methodology, and I'll show you this over and over again, is when you have the previous swing, and you go through the 50% area of the previous swing, you take off a third of your risk. Okay, you take profit. Then when you get to the 100% level, which would be up here, you take off another third, and you let the last third play out. So basically what we did here is this impulsed up, we were in our resistance area. Now from here, what we said was watch for support here at 56s. Why? Because it's a floor ceiling area. Okay, we got the back test. Did we get exactly to the number? No. Okay, but the floor ceiling played out. Why? Because this was resistance. We needed a back test. We had some news, by the way, on Sunday, right? If you guys remember, and we opened lower. The purple line, by the way, is the weekly pivot. Okay, now the weekly pivot is a very important level on a weekly basis because normally it gets touched at least once a week. So from here, our technical analysis was watch for this level as support, because if this is a high, and if we're going to turn, and everybody wants this market to turn, right? Our technical analysis was if we get support, get long. Okay, that was our technical analysis. And if we break through, then the bears are making a statement. Okay, so, this was our analysis, and what happened? We got into this area. It seemed impossible given how this market has been trading, right? But look what happened. We gapped down. We got into this area, and the trade was to get long with a stop, with a reasonable stop below this level here, which was 56.25. Okay, so what I'm trying to show you is a setup. This is a setup. Okay, 3 waves down to a previous resistance. Okay, beautiful setup. So what do you do there? Even though everybody wants this market to go down, you get long. Okay, this is what we said on the weekend, and it played out up into this area, and we were calling for 99s, 94s, whatever. Okay, 93s was the first target up to 99s, and we found resistance here. Okay, now what did we do? We said, and I'm going to do this again, guys. I'm sorry, we do the same thing over and over again. We said, and I'm going to make the line thick, floor ceiling. Again, same exact thing. Okay, thick line there. Okay, we said the bears have to break this level. Okay, this is the next support level, and if the bears don't break it, well, it's not worth getting short this market yet. Okay, if you're a longer term swing trader, that's different. If you're trading this market day by day, you're looking for the setups. Here's a setup, okay, in terms of a double bottom, and you could see this as a potential impulse, a higher low, etc. Okay, and of course you would leg out of this as you went up. Here you get into your target area, you expect resistance, you see resistance. Okay, that opens up the downside. Would I recommend getting short here? Not really, not unless you're a day trader. Okay, if you're a day trader, yeah, then it makes sense to get short. However, the Sunday open, you can't predict what's going to happen on a Sunday. It's very difficult, and I don't know that it's wise in a market like this right now to be holding if you're a day trader over the weekend. Okay, if you're swing trading into the June timeframe, which we're expecting a low in the mid-June timeframe, well, of course, you would probably leg in here. You may leg in higher. You would probably leg in as a swing trader in multiple places where there's resistance. Okay, but as a day trader, you look for the setup, you let it run, you look for the next support area, and you say to yourself, this is an either-or decision. Okay, right here, this level is either or. Either we find support or we don't. Okay, we break through, it's a bearish statement. We don't, it's bullish, get long. So get long, and what do you do on the way up? And here's the deal. You do the same thing you did before. I'm going to talk about the same thing over and over because you want to repeat and be consistent in how you trade the market. So 50 back right here is typically where the market turns. You take off a third, you put your stop to even, you let it run. Okay, what happened? It back tested. By the way, this very easily could have broken down. Okay, in which case, at least we take off a third. Okay, but in this case, we got lucky. Okay, we found support at 66, roughly speaking, right, which is the golden ratio zone, by the way, just from a technical analysis perspective. You go up into the 50 back or the 618 back position. Okay, typically you'll find support around the 382. Okay, usually you stay inside of that golden ratio zone and then you impulse from there. So that's what happened there. And are you adding to your position? No, you're legging out. On the way up, you take off a third. You wait for three up to finish. You take off another third, and then you leave the trailer on until you get into another area of resistance, right? Now, this support, this floor ceiling here, okay, and I said this last night, until we break this area, the bears don't have a chance. The bears' very first statement is to break previous resistance. This is previous resistance. Look what's just happened. Okay, now this has happened in Globex. I don't put a lot of weight on this in Globex right here. We could reverse from right here. And by the way, I would say without me looking around the market, I haven't done that yet, but my call for this evening is likely to be this. If we find support here, even though we've penetrated that area just by a handle or so, if we find support there, we're going higher. We're going into the 114 area. That would be my call because this appears to me to be a flat. We have 3 down for an A, 3 up for a B. Okay, hold on a second. This is like real-time live technical analysis I'm doing, right? Okay, so 3 down for the A, 3 up for the B, 1, 2, 3, 4, 5. That's a flat, an A, B, C. There's your X wave. Okay. Have we penetrated this trend line? Yeah, we have. That's disappointing, okay? I would rather it not have done that, but we find support here this evening in the next hour or so. Look where the RSI trend cycle is. We're breaking above it. okay? We bounce from here if this area, if, hold on, let me be precise, if 81s, if 81, 80, or 80, 50, 81, if that area turns into support, if we do a little back test here, right? We do a little back test here like that, and then we come back and do a retest, okay? And we come back into the 80 area, and that is support. That is a long. I get long, I put my stop below, and I let it go. And I let the trade go, and what do I do on the way up? I'm going to do the same thing, guys. Sorry, I know I sound repetitive, but, you know, 50 back. Where's 50 back? At 90. Where am I getting in? I'm getting in at 80. What do? I take off a third. I take 10. I wait for 3 up. I take off another third, whatever that's going to be. That could be 20, okay? And then we hit 14s, hopefully. You know, who knows what will happen? We don't know what will happen in the market. Nobody does. And we're playing the game of probabilities here, but I'm trying to demonstrate here, guys, what a setup looks like, okay? So here at this position, here I have divergence. What's my setup? My setup is a day trade short. Is my setup a big short? No, it is not. Why? We haven't broken this area yet. The bears have not made a statement yet. Okay. Am I big short here? No, I'm day short here. Okay. Why? Because we have not broken this area yet. The bears have not made a statement yet. Okay. So you know, I would advise you guys to trade setups only. Okay. So look for support and resistance, trade setups, get long at areas of support, get short at areas of resistance. Okay. You know, in terms of trying to call the turn, I think calling the turn is something that experienced traders do not do. You trade the market in terms of setups. You look for setups both long and short. And I'm an equal opportunity employer, guys. I'm not a bull. I'm not a bear. I like playing both sides. I just want to be on the winning side. That's kind of my basic philosophy. So, that's kind of.
I was saying exactly the same thing to somebody yesterday.
Yeah, very good.
It's the any team with choice.
Right, absolutely. So again, look for the setups. So far in this impulse, I want to share with you where the setups are. Okay, here was the first setup, the B wave. Okay, that was a setup right there. So that was a setup to get long. This was a setup. We're at our resistance area. So you take, if you're a day trader, you would take a short here. Okay. However, this is a bullish. We're in a bullish trend. So you have to be careful counter trend trading. I wouldn't be swing trading. If you're a longer term trader, you can swing trade this into July or into the end of June. I think that's a fine play at this point if you're playing options or something like that. But, you know, this was the other beautiful setup, which was on Sunday. You know, we hit this support area. The bears did not penetrate this. Now think about this for a minute, okay? Here's the previous resistance, here's support, and the bears in Globex could not penetrate it. What does that tell you, okay? The bears aren't ready yet to make a statement, okay? We impulsed higher, okay? Back test, we never got to this area. What does that say? The bears aren't even strong enough to get to 81, okay? 81 is a significant level here, okay? So 3 down, 3 up, here's a 5 down. We're now potentially at a flat. This could go higher, okay? Until we break 80s in a significant way, that's the current support resistance area, right? If we find support here, guys, it's a long, okay? And you get long, you put your stop below, and you leg out. Again, I'm going to be repetitive here. I hope you guys see what I'm doing is I'm intending to be helpful here, not, I don't want to sound like a broken record, but again, you get out at 91s, a third, you leg out on the way up, you take your profit in case it goes against you, because what could happen here, and I want to point out the obvious, at least I think it's obvious, we could do this, come up to the 618, 94s, that's maybe a lower right shoulder or maybe slightly higher, whatever. This could happen tomorrow. We could do this, and that would be a reversal pattern, and we could do that. Okay, so, you know, do I know that's going to happen? I have no idea. Does anybody know? Nobody knows, okay? But what I do know is this. I know that there's support here, okay? And if I see it, I trade it, okay? And I don't have a bias whether this is going to go up or down, okay? I'm trading the setup, and that's kind of it. So, Jack, those are the points I wanted to make in terms of just seeing setups and trading them. And by the way, if I'm in this nonsense here, up here, like up here today and yesterday, it's like, what do I do up here? I have no idea what to do up there because there's not a decent setup. Okay, I wait for the decent setups where I see really significant support and resistance, and the most difficult thing in trading is waiting for the setup. I think that is, that's what makes trading, I think, difficult. So
Yep,
anyway.
I couldn't agree more. A lot of people just cannot wait.
Yep, right. So those are my comments. If you guys have questions as we go, just name them. And we're going to get into managing risk in a few minutes, but we're just trying to talk right now about trading setups and give examples. Okay, so over to you, Jack. And
Right, I'm going to show you a couple of examples from today, and I'm going to show you a couple of examples as it pertains to the close tonight, because one, this is of immediately direct relevance, so it's easier to understand, and two, because it might actually help you in your trading tomorrow. So let's have a look. Now I'm just drawing this. I posted this this on Twitter later this afternoon, and this is if we go back and bounce tomorrow. And do a retracement or do a new high, this is the main pattern which is going to be driving that. Posted it on Twitter earlier this afternoon, and this is a falling wedge. Now what I commented on these, and it's worth knowing the stats on these, you can get these from Bill Kowski's website or books or so on. It's these break up 70% of the time. So I posted it when I think just after we'd made this low here, when we had a clear three-point trend line there, and it had resolved into a recognizable pattern. Now, there's a couple of points to note about this. First thing, we go down through support. What's that? That's a bullish overthrow. Or at least it is unless it continues down. Had it retested, found resistance at broken support and headed straight down hard, then it could have been that this was taking the 30% option of breaking down instead. But as it is, it retested, came back, retested that as support, back up, and so on. It then comes back, and this is something very well worth remembering on entries, because People will often tell you that entries don't matter as long as you've got the direction right. That's total bollocks. That's absolutely rubbish. Entries are vitally important for, if any, for the very good reason that the sooner you can take your risk out of a trade and go even stop, the better. Yeah.
Agreed.
The better your entry is, the less likely you are to get stopped out afterwards. It's really, it makes your trading a lot safer and a lot better. It is worth taking the time to develop the skill to do decent entries. Now, what do you notice about here? We come up, we break up from the wedge. Is it a point to, as soon as you break up from the wedge, do you buy that breakout? No, because a lot of the time, well, occasionally you will find it goes straight up, generally on a news announcement or so on, but generally speaking, you're then looking for your reversal pattern. What's your reversal pattern going to be? Likely is it's going to be an inverted head and shoulders, or it's going to be a double bottom. On SPX, tops and bottoms, I reckon they're about 70% double bottoms to 30% head and shoulder patterns. Maybe 25% head and shoulder patterns and 5% other stuff. So what does it do here? Comes back, retests the low, makes a slightly higher low. And as it is, this is actually, that looks like a double bottom, but it isn't. This is an inverted head and shoulder pattern. You've got left shoulder, complex head, right shoulder, and if we break up tomorrow morning, which we might well actually, then it's going to be on the basis of this pattern, and you can see that the target's going to be in about this area, so just past the 38.2% fib. Now, there's two sorts of wedges. They look identical, but they're different in effect. You've got a full reversal wedge, a termination wedge, basically ending a trend, and that will do, the target for that would be a full retracement, and that would be probably the obvious target if we have a hard breakup, and it is very much the obvious target if you go beyond 61.8% fib retracement. If you're looking at a continuation wedge, where basically wedge down, retrace, and then next move down in whatever pattern that develops, then really you're generally looking for a, not always, but I'm usually looking for a target in this range here, which is 38%, 50%, 61.8%, and you're looking for signs of reversal there. All right, great. I just want to make a couple of other comments about the setup today, because there's various other, I captured a couple of futures charts. And I'm going to talk about entries on these too. This is when it finally shows itself. Okay, good. Can you see that all right?
Yeah, beautiful.
Yeah, right. This is the NQ chart, and this is a very nice head and shoulder pattern that has been forming. The shoulders are about the left shoulder and right shoulder, even though it's a sloping neckline, should be at about the same level, and they are nicely formed and nice clean trend line. I went point to point without Pinocchios and so on and so forth. It's a nice, decent trend line. It hadn't broken down at the close. Google announced their earnings, and off to the races. Now, this is something, again, you need to bear in mind for tomorrow morning. This has broken down. If it continues to break, and it's also got a target at a very obvious support level, and this would be on a bigger picture, this would be another head and shoulder potential neckline. So it's got a big support level, it's got a target there, and it's broken down. Do you dive in short here? No, because it's not a very good entry. The head and shoulders could still fail overnight. We've still got that bullish setup on SPX. That could play out. It doesn't have to play out, but it could. Personally, my lean is probably a bit down to tomorrow, but it's a mixed picture. The better you make your entry, then the more easy it is to trade this and the lower risk it is. Where do you want your entry to be here? You want it to be here. You want it to come back and retest the broken head and shoulder neckline. And a lot of the time you'll find it comes back and does exactly that. A lot of the time it will come back, do that, and reverse at that level. So you're looking for an entry, maybe 45.11? 45.12 if you're thinking of cutting it very fine. But remember, the tighter you draw it, the more chance there is that it actually will come close and not fill. So there is a balance on these things. But certainly, if you were planning to go for 45.11 and maybe with a stop at 45.21 on this one. If it goes over, I mean, the head and shoulders only gets invalidated at about 45.55, but unless you're willing to take that kind of heat in terms of your stop, you probably want to set it at another level. And really, you want to set it over the neckline, because a lot of the time it will come back, it will retest the neckline. So you're doing an exploratory one here, and then what's your risk reward there? 45.11, stop back at 45.21, let's say, or 45.18. It's and what are you looking for? You're looking for 44.28. So you're looking for, what is it there? 85 points, 85 handles with 10 handle stop. Good risk reward. It might not fill, but in that case you lose no money. It might fill and stop out, in which case you can always have a look at it again. But if it, a lot of the time, will come back, do that retest, and then head down to the target, and in that case you get paid. And it's a very nice risk-reward trade. That's just one example. I'm going to show you another one from today as well, because this is further fogging the picture for tomorrow morning. And that is on TF. What have we got here? Nice rising wedge, 70% bearish. It's broken down. What are you looking for there? Topping pattern. What's it formed? Nice double top. And that has broken down as well. Now, obviously, that's got a target down in the 11.21 area. Again, it's a decent support level. And another possible larger head and shoulders neckline. It could make it. Again, I mean, here, actually, this wouldn't be a bad entry. To get short near, because you're close to broken support. But what you do need to remember on these things is these patterns, both double tops and head and shoulders, were the most likely area for them to fail, and fail hard, because when these fail, they do tend to fail hard, is just after the break of support. And if it failed hard, it would be heading off to, you guessed it, new highs, exactly the ones that Stan was talking about. And if these do fail, then that should see at least a retest of the highs on SPX for that reason, because we've got these two topping patterns which would then not be delivering. All right, great. Shall I throw it back to you, Sam?
Yeah, sure. There are a couple of questions here too, Jack, I want to try to answer.
Yeah, sure.
Is this recorded? And Rita, yes, it is. What would you call a significant break? And I want to actually show you on a chart, Pat, what I would call a significant break. And you've mentioned that on certain legs there are no divergences on RSI. Can you get into this? And David, I can. I will in a moment. But I want to answer the significant break question first. And what I'm trying to do, guys, is I'm trying to answer three questions at once. Story, you have a question about if you are short in options further out, say mid-June, what would be different about the setup you would be looking for, and what is the difference in how you would look at the setups? Okay, good question. And by the way, that relates to Pat's question, which is how many points is a significant break, as well as how much do you risk. Now, what I'm showing you here on my chart is the S&P monthly, okay, and I'm doing this to make a point, okay. Here's a nice way of looking at setups, okay. Look at RSI, okay. So here's what I call the RSI price cycle, okay. So on a monthly basis, what happened here in 07? We peaked in RSI, then we put in a divergence, okay, you can see it there, and what happens is you break the price cycle, you back test the price cycle typically, okay, and you wait for that setup right there. Let me put a box on it, okay. Now, if I'm a longer term trader, I'm trying to answer one of the questions here that Story asked, is I'm looking at a longer term chart. Okay, I'm using the monthly here as an example. I'm going to get to the daily in just a few seconds. But look at the setup there, okay? We got divergence on a monthly basis. We've crossed the RSI price cycle where we hit 70, okay? That's a setup for a long-term swing trader, okay? And by the way, look at the month. The month had a range of, I'm just going to say that the month had a range of 86 bars, okay? 86 handles. Now, if I'm a longer term swing trader, 86 handles is not something that I'm worried about, okay? I'm setting a 50-point stop because I'm risking 50 handles in order to capture a correction, okay? So, you know, if I'm trading a longer time frame, I'm using different technical analysis. So here's a way of looking at longer term time frames. Here's a divergence on a monthly basis. What do? I risk 50 to make a lot. And I don't mind risking 50 handles in an option, in a long-term option that might be over a year, okay, to do something like that. Now, by the way, this was an exceptional decline, one that we may never see again, caused by the dollar devaluation, etc. But look at this setup, okay? And by the way, we called 2138 as a ceiling, okay? Based on this decline, that's where it came in, 2138, and we got to 36s or 34s or whatever. But look at the setup. Divergence, I'm sorry, not divergence, RSI price cycle, you break it, you diverge. Where did that happen? Right here on this bar. What was the high on that bar? The high there was 2119. So in a lower level chart, of course, you know, when you look at a monthly basis, guys, you go to a lower level chart for your entry. You look for things to line up, you get short, you set a 50-point stop, okay, 50 handle stop. But basically what I would be doing here is playing a longer term option out at least a year and going deep in the money. Okay, that's how I would be doing it, and that's to avoid premium decay. Okay, anyway, so you're playing a longer time frame. You're trading for a year. Okay, to trade for a year, you look at a monthly chart. Now, most of us here don't do that. So let's talk about this on a daily basis. Okay. As a matter of fact, I could talk about this on an hourly basis. That might be better.
And actually, you'll find that you can use pretty much the same techniques on a 1-minute chart.
Yeah, right.
Although,
yeah, please, Jack. I'm sorry. Go ahead. Yeah,
I was making an observation. What you were talking about there, which is basically, you know, selling a back test after a bearish break. That is an absolutely classic technique. You can you do it on RSI, you can do it on price, but it's really you don't tend to trade the break. You're really far more interested, and you get a better entry on the back test.
Right. Now, longer term trading, if I'm a swing trader, right, and I'm looking at options further out into mid-June, I'm looking at a daily chart, okay, and I'm not looking at the hourly chart. I'm looking at the hourly chart for 2-day to 2-week swings, okay, which is what I try to give subscribers, okay? And by the way, if I'm looking for a day trade, I'm looking at a 3-minute, 5-minute, 3200 tick chart, okay, for day trading. So your time frame has a lot to do with your technical analysis and how long, you know, how long you're going to hold your trade. So here on a daily basis, look at the divergence right here, okay? It's the same basic thing I just showed you, RSI price cycle, okay? We get a break, okay? No divergence there, right? A back test, and we have divergence, and I mentioned this last night. We have divergence. That could be a potential high. I mentioned that, and I said we could go higher, and nobody knows. But here is where, on this bar right here, which was yesterday's bar, which, by the way, was a doji, which is a very interesting thing on a daily basis to notice. The high was 2111, okay? The low was 2096. Now, do I care where you get in? As long as you get in on that bar, I don't care, and I would be holding that until June. Okay, and by the way, I'd be using a big stop. I'd be using a stop above 2138. Why? Because 2138, as I showed you on the monthly chart, this chart is a ceiling. Okay, so I feel very comfortable trading this long term. Okay, given this setup divergence, and by the way, I could be wrong. This divergence could break. Okay, and if the divergence breaks, well, then I'm wrong and I take a hit and I go on to the next trade. Okay, that's trading. But I'm trying to demonstrate how would you trade for a longer term hold. You wait for the setup on a daily basis. Not a lot of people have the patience for that, okay? So you've been waiting for this setup since mid-February, okay? Since mid-February, you've been waiting on this setup to get short because, you know, we believe we are in a correction. I still believe we are in a correction. This is not a bullish move, okay, in my book, okay? So if you're going to trade it short, you wait for the setup, and this is what you would wait for a multi-month setup, is trade the daily chart. So I tried to answer two questions. Okay, so when you make a call, how many points in terms of a break, Pat? If I'm trading a monthly chart, I'm looking at 50 handles. If I'm trading a daily chart, I would use, are you guys familiar with using average true range, okay, on a daily basis? Let me just add that to my chart real quick here. It should already be on there. Yeah, there it is. Okay. So average true range is a wonderful indicator of volatility. Okay. Now, what this is telling you on a daily basis is yesterday's number, average true range, was 13 handles. Okay. That's the average true range of the market right now. I would be setting at least a 33% stop. So if I got short yesterday and I'm holding a multi-month trade, I'm looking at ATR and I'm giving it maybe a 33% to a 50% stop. So right here, my stop would be 6 handles to be safe. Okay, I'd get in at a decent level, set a 6-handle stop to be safe, and let it go. Now that's very different, of course, than trading a market that does this. If I'm getting long here, okay, and I think this is a bottom, well, I look at average true range and I'm not using a 6-handle stop. Look what I'm using. Our average true range is 63. I'm using a 20-handle stop here, okay? So your stop methodology has to relate to volatility. If you are using 2-handle stops everywhere, guys, I'm sorry, you're going to get stopped out in volatile markets and you're going to lose money. You have to adjust your stop system according to volatility, or at least, you know, keep that in the back of your mind, at least in terms of thinking about it. So I'm trying to answer, Story, your question about options and further out, and Pat, your question also about breaks. Now, let me get down to a shorter term time frame. So I have a feeling, Pat, your question related to this call that I may be making this evening, which is if we find support at 81s, how far is my stop? My stop would be below the current low. That's where it would be. Okay, so if I'm short-term trading, I'm using stops in relationship to structure. Okay, so the current low right now is 78.75. I would probably, looking at the structure here, there's not a lot of support in this impulse right here. So, you know, I would say I'd be setting maybe a 2 or 3 handle stop below the current low, just to give it some space. Okay, if I see 81s as support this evening. So, you know, on a shorter term period, guys, as your charts get smaller and smaller, your risk gets less and less. Okay, so depending upon your account size, you have to be looking at the right size or the right time frames, I should say. Okay, so long-winded answer, but I'm hoping that you get sort of the mindset in terms of how you look at longer term trading, et cetera. So, Jack, you want to add anything to those questions? Longer term options trading or longer term trading?
No. Well, this might be a good time to talk about the yen, actually. What do you think?
Let me throw it back to you. Sure.
All right.
Great opportunity for that.
Yep. Now, this is a long-term chart. Obviously, this is actually a weekly chart, but this is spread over 13 years, and this is the yen. It's actually shown upside down to the usual way because I tend to chart it as JPY USD, whereas for some reason most people seem to chart it as USD JPY. Everything else, all the other US dollar currency pairs get get traded the other way. Anyway, for whatever reason. Now this was the big bull run between 2007 and the top in 2012. Was it late? Very late 2011, beginning of 2012. Nice rising wedge, and it formed, and it then broke down, and I'm just going to talk about the trading opportunities in here and what you are looking for. And I've been watching this for years, and in amazement, really. In 2009, 2010, I was just thinking that it just kept going up and up, and it was a flight to safety currency. And the idea, I mean, the Japanese are bankrupt on a reasonable measure.
Are they ever?
Comically so. The idea that the yen was a flight to safety destination was just a cosmic joke. But nonetheless, you know, it was going up. Got to respect the trend. I called this short in October 2012. Why did I call it short? Well, look at the structure here. We've got a nice rising wedge, and when you're getting close to wedge resistance, you don't necessarily get a good decline. But if you're seeing some signs of reversal and you're close to wedge resistance, it's always worth a punt for a short. That is a nice entry. You may well be getting out when you get out to go from wedge resistance to wedge support, but you then get here you've got a breakdown, and then you've got a rally. That rally is putting in a clear head and shoulders, and actually I called it short here. It had just made the second break below wedge support, and I called it short here and said this is a nice looking short. Obviously the yen's a total joke. And it's been coming for years. This has been forming for years, and this is a nice short entry. And I was looking at it right here. We'd made the second break below. It was obvious that a part formed head and shoulders on the table. That the target for that head and shoulders would be down here, and that actually, given that how weak the yen was overall, it might well do the full retracement and come back right back to the bottom of the wedge, 80.55. And of course it got down to 79.46. So that was a nice short. Was I looking at the news? No. Was I aware of what the central bank was doing, what Japanese policies were? No, I was just looking at the chart. It's an interesting, very technical chart. How much impact did the news actually have on it? You got to wonder about that, and you got to wonder about it even more when you get down here, because what happens when you're retracing this wedge? Another pattern will form. Generally speaking, it'll be a channel, a megaphone, or a wedge. What have you got here? You've got a very nice falling wedge, and it comes down and it breaks up, and we're talking about it again in chart chat, and I'm looking at this potential IHS forming here, and this was August last year. And talking about it again in September, October. Was I talking about central bank policies and how the market was digesting those? No, I was just talking about the pure technical retrace here, and the pattern that might be forming here. And of course we've got our clear resistance level there and neckline. This retest of this low is an interesting low risk entry, where just as this was an interesting low risk short entry, this was an interesting low risk short entry. This was an interesting low risk long entry. You don't buy the breakout, you wait for the retest. You won't always get a retest, but you'll get a far better entry if you do. And you're mainly interested in improving your odds on the trades you take. Missing some is just part of the game. Now, it then breaks up. What does it do? It goes up to target. It is stalled there at the moment. Quite often you'll find that these things reverse at the targets. What you're looking for there, you're looking for signs of reversal. Are you near any key Fibonacci retracement levels? 23.6%. 23.6%. Yes, but is this normally a target? No. Where are we looking for the target? Well, if you look on the really long-term chart, and this one goes back to the early 1980s, what's the bigger pattern that these are actually effectively just a part of? Well, this is a huge rising wedge, and this was the last thrust up within that rising wedge. This is broken down under it. What do you normally get? You get a retest. You get a backtest. So I was talking about this last year and this was with the yen at 81 and everyone having pretty much written it off, and I was talking about a technical backtest to get it back to 95, 96. And that is well in progress. I think there's a very good chance to get there. What to do, when to get there? I'll be looking for signs of reversal, and at that stage I'll be looking at a short entry. But this, ideally, you'd get back to 99. That's really the minimum you should do. But I mean, the yen's in serious trouble. Japan is in serious trouble.
Oh God! It's amazing how big the trouble is there. It's amazing.
Yeah.
There's gonna be a collapse someday. It's coming.
There is. I mean, it's years since, I can't remember which Nobel Prize-winning economist said the Japanese were a bug looking for a windshield. But you know, they're still looking. Sooner or later they'll find it, and at that stage they're going to have real trouble. Anyway, so ideally you get up to 99 here. I suspect it's going to fail lower. I would really like to see it up here at about 96, 97 and fail there. And I'll be looking very hard on the daily chart for signs of failure there. And what would be happening there? I think ultimately there's a pretty good chance this is going to retreat. This is going to go all the way. It's going to head right back to 36, i.e. dropping over 3/4 from the peak in 2011, and this will be looking at a very nice short entry on the way, and that's what I'm looking for. But I have been reading a lot about you know, the market, and the yen is rallying because of the market's losing confidence in the in the Japanese central bank and so on. I think this is just all garbage. There's a whole industry devoted to tying up the news with what's happening on the markets. This is pure technical action. And this is an oversold bounce and a retest of broken support. I think when that retest is complete, I think, again, regardless pretty much of what the politicians and what the bankers are doing, it'll head down to the next stage. All right, great. So let's talk about the yen. Where are the good entries within this? Well, there's a good short entry there. This was obviously a visible short entry because of the wedge. There was another short entry there. There was a long entry potentially there, but it didn't work out. There was a little other pause here, but it continued down. Did the full retracement. When the wedge broke up, then wait for the back test, and there's a buy there. You'll often be able to see the turns and the divergences and so on the shorter term chart, so you can use those to refine your entries. You work out what the pattern's likely to be. Inverted head and shoulders is pretty obvious from the top of this candle here. It's and it delivered. You measure out the target, and that's where it's got to, and it's stalled right here. This is all just a matter of optimizing your odds, being aware of where things are likely to go on the way, and seeing if you can get on the train at the right place.
Yep, makes sense.
Yep. All right, great. Throw back to you, Steve.
Okay, great. I want to cover one other thing, Jack, and then we can get to risk management. First of all, how many of you listening here make 40 to 50 handles a month? Okay, I'm going to give you a trading system right now, and it's very simple, and it's a way for you to make 40 to 50 handles a month, and you'll only make 1 or 2 trades a month. Okay, but that's the hard part of trading is not getting involved and waiting for the setup. And I'm just going to answer this. There's a question that was asked. The question was asked, how do you use divergence, and how do you trade something when there is no divergence? Can you get into divergences? Okay, so I'm just going to do a real quick example of divergences on a 1-hour basis. Okay, so let's say we trade divergences only. Okay, there's your trading system. So where's your first divergence? The month of February. I make a trade, I get in here somewhere, okay, in here somewhere, okay. I get in because there's a divergence, okay. And what do? I get out 50% back, which would be right about here, okay. So that's a profit maybe of, let's see, from 15, let's say I get 50% back to 51. So let's just say that's 30 handles or so. So let's say I make 30, 35 handles. I get out of a third, I let it run to 100%. 100% fib would be right here where this box is. That's why the box is there. I get out of a second third. So I've run from 15s all the way up to 91s. Okay, that's a nice trade. Okay, I get out of my second third. I let my last third run. I see where I'm at with RSI. I'm above 70. I punch out. Do I need to catch it all? No, but I've just made a great trade for the month of February. That's one trade. By the way, where's the next divergence? Right here. Let's look at it. Let's say I'm just going to trade this on the short side. Let's forget about the long side for a minute, okay? And the point I want to make to the gentleman who asked the question is, you're going to see divergences typically in the direction of the counter trend move, of counter trend. You're not going to see divergences in the direction of the trend. So here's a direction. Here's a divergence indicating we're going to get a back test. Here's a divergence indicating we're going to get a back test. Here's a divergence indicating we're going to get a back test. Here's a little mini divergence, hard to see, that we're going to get a bullish impulse, okay? And here's another divergence indicating we're going to get a back test. So if you traded just the counter trend divergences, this one here from the W to the X, that's at least 40 handles, okay? No trade here. Here's a divergence, okay? Here's your Y on a divergence. There's another 40 handles, okay? Here's another divergence, okay, in the month of March. And you would get in on this bar here where the divergence is, right? That's more than 40 handles. How many handles is that? That's 73 to 34s. You know, so there's roughly 40 handles there. So, you know, I think trading less and I think finding high quality setups are it's a dilemma for traders. Okay, I think it's a dilemma. So, you know, do we want to be active or do we want to be productive with our time? And that's the challenge. So, you know, divergences are very important. And by the way, you'll notice, is there a divergence here on the X? Nope. Is there a divergence here on this X? Nope. So typically in a trend, the X waves will not have divergence. Typically, okay, and typically the bullish impulses or bearish impulses, depending, you know, if the trend reverses here, we start going down, this will flip in the opposite direction, okay? So, you know, if you're paying attention to divergences, just trading that on an hourly basis, guys, you know, and you're very picky with your setups and you're a swing trader, you will make money, okay? You will make money. Okay, so we have other questions, Jack. I just wanted to cover the divergence question. Okay, yes, this will be recorded. Okay, how do you trade it if you break support? Okay, that's a good question. Let's go back to ES. Okay, this setup here that we're talking about now, remember the W, that's resistance, right? It should be support. If we find support at 81s, get long and set a stop below your low, right? Okay, what happens if you break the low? Well, you're stopped out. Do you look to get short right there? My answer is no. You don't chase a trade. You wait for the next setup. So the next setup might look like this. We might break through. We might find the weekly pivot. That's what this pink line is at 62. We might find support there. That would be a natural support area. We might see a back test. The back test would typically come back 50%. That would be in the range of at least that may go a bit deeper. We could go and see 84. So, you know, we would wait for the back test of this floor ceiling. That's why it's called a floor ceiling. Okay, right here it's a ceiling, here it's a floor. Okay, if we back test it and it becomes a ceiling, guys, that's where you get short. Okay, so you break this, you get stopped out. What do? You reevaluate. You look for the next setup. Okay, and you don't trade anything but setups. I think that's the discipline of trading.
Yep. And generally, as a general rule, it's never a good idea to chase.
Yep, absolutely agree with that.
Because almost always you've got bad entries.
There's a question here I don't understand. If you could clarify, please. Are this divergence doing well in lower time frames too? Oh, absolutely, yes.
Absolutely.
But again, I think if you're trading a 1-minute chart, your swings are not going to be 40 handles. Okay, so if you're a swing trader, you're trading an hourly chart for like a 30-40 handle swing. On a 1-minute basis, you're trading for a 4 or 5 handle swing. I would say, Jack. Would you agree with that?
Yeah, I would.
Okay, so time frame has to do with your TA and also how much risk you're putting out. And by the way, the technique I showed you in terms of 50 back, take your profit. Okay. Like for today, if you were short up here, 50 back right here at 93s, you would have taken a third off. Here, I would have 2/3 off. I'd have a third left with a stop above this high right here. If I were short, the high is 88.75. I would have a stop right there, and I'd let my last third run. Okay, lock in the profit. Okay, the last question we have. Oh, I'm sorry, Jack. This is for you. This is from Ben. How do you trade the yen specifically? The setup that you just went over. Can I throw you the chart back?
Yeah, sure. No worries.
Okay. Let me throw it back to you to cover that question.
Okay, I will need to ask a couple of questions about what exactly he means by trading the yen. What is he talking about? Where do you look for the entries? Is he talking about what instruments do you trade?
I think he's talking about instruments. What instruments do you trade? Right.
Well, you can trade the instruments directly. USD JPY or JPY USD. Go long and short those. I mean, I'm my main background is as a forex and futures trader, so that's in the sort of the normal routine really. You've also got yen futures, which you can trade, which are very good. The European futures, sorry, the Euro USD futures are very, very widely traded. So are the pound. The yen are okay.
Yeah,
there are also ETFs.
Mm-hmm. I just wanted to say I would avoid ETFs because you're locked out of the market because currencies trade 24/7. You're better served dealing with exactly what Jack just said. USD, JPY. Look at a futures contract of some sort. I think you're better served that way. Currency,
I would agree.
Yeah, being locked out is not fun, guys. For me.
No, it is. I was talking about this. I was talking about this on Twitter a couple of days ago. I was saying that. I mean, obviously, with respect to a lot of people do very well on options. A lot of people do very well on ETFs. But I mean, the fact is, each approach has strengths and weaknesses. The great strength of futures is the fact that it trades more than anything else apart from forex. And you can you're unlikely to have huge leaps over your stops unless you are leaving your trade on over a weekend, in which case obviously you can consider the risk on a case-by-case basis, and so often you'll actually just exit on the Friday, late on the Friday, and get back in at the open on Sunday. So but the thing is, you really do know what your risk is pretty much all of the time on futures, and futures and forex, you can put in your stops very exactly. You've got big liquid markets, generally speaking. Obviously, some of the more thinly traded futures.
Oh, I tell you what, USD, JPY, very liquid, guys, very liquid.
But I mean, you're generally better off trading the biggest, most liquid instruments, and you've got the depth of the market, and so just trading USD, JPY is a nice big market. And that's the way I'd recommend doing it. You can do it with ETFs, but I think doing it with ETFs is an inferior method. And you also need to check very carefully into the ETF to see how good a job it does of actually reflecting the instrument. The variability and the quality of ETFs is extremely high.
Very good.
So, especially leveraged ones.
One other question that I want to ask, which was on our outline, Jack, which is about risk management. When do you risk and how much do you risk? And I just want to share a philosophy. I'd like to hear your answer to the question as well. But I think what happens is you have to look at the setup that you're in and look at the overall situation and decide, okay, so what am I putting on a trade? Okay, so typically what I do is I'm putting on 5% of my account. And that may seem like a very, very small size, but guys, I very seldom, if ever, get over 25%. I'll go 20% sometimes on a trade, but it's not very often, and only if I have significant support and resistance. So like, for example, when I showed you 2138, that's significant monthly basis resistance, okay? So I will trade against that, and I will use 20% of my account. But, right here, right now, what do I have here that says that this is the high and I should get 20% short here? I have absolutely nothing that says that this is now a bearish trend and that we're turning. I have no confirmation. We haven't even broken this previous resistance yet. So, I'm 5% in, and that I'll finish, Jack. That's the point I'm trying to make. It's like, look, trade small pieces of your account until you get a real confirmation, and then you can put larger pieces of your account on. But there are people that I know, they start trading and they're putting 80% in on a trade, and those are the people that lose their account. They blow up. And guys, enjoy trading, love trading, trade small. You'll win more often. You'll have less psychological pressure. 5 to 20% is a good position size. Leg out on the way, as I've shown you. Leg in and leg out of your trades. And I think you'll be at it for a very long time versus the people that bet it all and lose it all. So that's what I wanted to say about that, Jack. I'm sorry. Please. Go ahead.
Right. What I would also say is the problem with going in too big is that you're liable to find yourself out of the game on a bad trade or two. You don't want that. One of your top priorities as a trader has to be to not wipe yourself out. because that is a very, very difficult thing to come back from, and it basically takes you out of the game altogether for a while. You need to go in proportion. You need to consider your odds. Now, I mean, to a certain extent, you need to put the work in so that you can calculate the odds in a reasonably competent manner. Otherwise, you're talking about garbage in, garbage out. You know, if the information you're putting in makes no sense, then what you get out won't make a lot of sense either. But that said, you've got a very you can improve your odds on a lot of things. You can learn how the various patterns behave. You know, you can learn about market structure, volume profile. There's some lovely work done on it. Divergences, RSI divergences. We talk about them a lot, and they rock. They're absolutely great.
Yeah.
You don't get them every time. You don't get anything every time. But you can. There are a lot of ways in which you can improve your odds, and just getting entries and exits right is an art form of itself, and one well worth practicing and mastering.
Yep.
Because it's far better. A lot of people will make the choice. They will go into a trade, and they will think, "I must be in this trade. Therefore, the entry is less important."
Yeah.
What you've got to accept is actually you've got to be relaxed about missing a number of trades because you never got the entries for them.
Exactly right. That's why size is so important. I have a question here, Jack. I'd like to hear your answer to it. So in terms of 5% of an account, okay, what if I'm a small trader? Let's say I only have an account worth $6,000. I'm just starting out.
Then in that case, 5% of your account's probably not realistic for a trade. So I would, with that amount, it doesn't take you a lot to put you out of the game. I would be trading it very carefully.
Yeah.
But obviously not on a 5% basis.
Yeah.
You are undercapitalized.
Yeah, you're undercapitalized to be trading futures is my first answer. Second answer is you need to be trading options to limit your risk. And I'd learn how to sell puts and learn how to capture premium because that's the easiest way to make money in options. And it's not a fast way to make money, but it works and it's low risk. You need to be looking for a low risk approach to trading to build up your account before you get into trading futures. I would not be trading futures with $6,000. You're asking to get hurt, in my opinion.
Especially assuming that you're starting off fairly inexperienced.
Yep, absolutely.
Which would be a reasonable assumption then.
Yep.
So also the other thing is when you're learning, do you consider paper trading?
There's a great idea. Great idea.
So you don't have to train on real money. You have to be aware that paper trading isn't exactly the same as normal trading. The psychological pressure is different. You'll find if you're trading on Think or Swim, for instance, and you're doing the paper trades on those, that all your fills are instant. Obviously, that doesn't happen in real life. But nonetheless, you can learn an awful lot about trading there without having to lose a lot of your account to get that. Doing it with real money is expensive.
Yeah, in terms of trading $6,000, I would look to sell puts in a bullish market of some sort, not indexes, but like a stock or whatever, and you sell out of the money puts, and there are guys on the internet who have services that you can sign up for, and they specialize in selling puts, and a lot of people who are retired who just want income, okay, they sell puts and they capture premium, and that's all they do. It's not a big money maker, but it's a safer way to actually capture premium out of the options market, in my opinion. So that's something to look at. We got 1 minute, Jack. Any closing statement you want to make?
No, I don't think so. What I would say is never underestimate the risk. I mean, you look at the yen charts we've shown you tonight, or various other charts. You're thinking about the direction, etc. Don't underestimate the quality of the mechanical skills you need to be able to trade. All these things like entries and exits, they're small, they're detailed, they're less glamorous. They're really important. At the end of the day, if you don't get risk management right, if you don't get entries right, if you don't have patience and self-discipline, it's going to be very hard to make any money trading.
Couldn't agree more. Well said. Well said. I just want to say thank you to everybody for coming. Good questions. The recording will be up on the site here probably in a couple of hours. So thank you, everybody. And Jack, great job as always. Enjoy working with you.
Pleasure as always, mate.
All right, same here, Jack. All right, take care. Bye-bye.
Take care.